Welcome to the debate. If you're buying commercial real estate, you measure the square footage, you inspect the foundation, you check the net operating income, and you just do the math.
Right, it's very tangible.
Exactly. It's grounded in physical, undeniable reality. But today, well, we're looking at a $29.5 billion company where the fundamental math says it should be worth like a fraction of that.
A tiny fraction, yeah.
Right. So we aren't appraising a building today. We're essentially trying to appraise a cloud. It's shape-shifting, it's moving, and the traditional tools of measurement just seem to, pass right through it.
I think that's a great way to put it, actually, because a cloud is entirely real, right? It holds massive amounts of energy and water, but if you try to measure it with a wooden yardstick, you're going to conclude that it has no substance at all. The tool fails the subject.
And that is exactly the tension we're exploring today with Qnity Electronics, ticker symbol Q.
Yep, the semiconductor materials giant.
Or, they're priced like a giant. They're currently trading at around $138 per share, with a market cap of almost $30 billion. And they are just riding this tremendous momentum of a post-IPO growth narrative.
Definitely riding a wave.
But here's the catch. When you run an exhaustive analysis of like 21 different standard valuation models, the consensus fair value lands at just $82 per share.
Which, leaves the market at a really fascinating crossroad.
Fascinating is one word for it. So, the central disagreement we are diving into is this. Are investors paying a massive 68% premium for a dangerously overvalued story stock that is actively destroying economic value? Or do traditional, backward-looking valuation metrics fundamentally fail to capture the forward-looking green flags buried deep in Qnity's footnotes?
That's the million or, I guess, $30 billion question.
Right? So let's establish where we stand. I argue that undeniable fundamental math, massive debt accumulation, and the valuation frameworks of legendary investors prove Qnity is structurally overvalued.
And I argue that strict adherence to those standard models creates a massive blind spot, missing critical indicators of future innovation, operational efficiency, and hidden assets that justify the premium.
Well, let's start with the math, because the trailing numbers you mentioned show a pretty stark reality of value destruction. I mean, the absolute bedrock of corporate finance is that a company has to generate returns higher than its cost of capital.
Sure. Basic Finance 101.
Right. Otherwise, why does it even exist? And Qnity's return on invested capital, their ROIC, is sitting at a mere 7.36%.
Mm-hmm.
Meanwhile, their weighted average cost of capital, the average rate they actually pay to get that money, is hovering around 9.5%.
Look, I know the numbers look bad on a snapshot basis.
But think about the underlying mechanism there. For every dollar Qnity raises and invests, they are actively losing over 2 cents in economic value.
On paper, sure.
It's not just on paper. They are literally borrowing at 9.5% to earn 7.3%. That isn't just a slight miss. That is like the mathematical definition of value destruction. And honestly, it gets worse if you look at their balance sheet.
Oh, here we go with the goodwill adjustment.
Yes, because if you adjust for the $7.5 billion in goodwill, which is essentially just the imaginary premium they overpaid for past acquisitions, Qnity actually has a negative tangible book value of $1.5 billion.
Okay, but
Let me just finish this thought. Almost every standard valuation model, from discounted cash flow to dividend discount models, tops out well below that $138 price tag. To buy this stock, you have to completely suspend your disbelief.
See, I come at it from a completely different way. I acknowledge those brutal metrics. The ROIC is indeed lagging, and yeah, the tangible book value looks frightening if you're just pulling up a standard screener.
It is frightening.
But evaluating a high-growth semiconductor materials firm like Qnity purely on trailing metrics paints an incomplete, almost deceptive picture. It's like driving by only looking in the rearview mirror. We have to look at the green flags that the headline-driven media entirely ignores.
Okay, I'm listening. What green flags magically override a negative tangible book value?
Look at their deferred revenue, for one. It is growing faster than their actual sales.
which is a liability.
Now, yes, in the software and tech materials space, deferred revenue shows up as a liability on the balance sheet, which, scares traditional investors. But operationally, it signals incredibly strong future visibility.
Meaning they have cash in hand.
Exactly. It means customers are handing over cash early, prepaying and locking in their supply. Furthermore, look at their declining CapEx intensity. Their capital expenditures actually fell to $285 million in 2025, yet their revenue grew 18%.
Wait, but dropping CapEx could just mean underinvesting.
Or it means massive operating leverage. They are squeezing more growth out of fewer dollars. The market isn't suspending disbelief. The market is pricing an option value and technological leadership that those historical models simply cannot compute.
You bring up option value, but if we're going to talk about value, we can't just ignore the foundational laws of gravity and finance.
I'm not ignoring them, I'm contextualizing them.
Let's actually test those historical models, though, because dismissing them is exactly how bubbles form. I want to methodically dismantle Qnity using the frameworks of the greatest capital allocators in history: Ben Graham, Peter Lynch, and Warren Buffett.
We can do that, but you have to recognize the context those frameworks were built in.
Math doesn't care about the era. Let's start with Ben Graham, right? The father of value investing. He built his whole philosophy around a margin of safety, looking at hard assets and reliable earnings to protect your downside.
Right?
If we use his classic formula on Qnity, the absolute maximum value you get is about $46.50 per share. That's exactly a third of the current trading price. And if you use his stricter net current asset value approach, where you aggressively adjust for liabilities, Qnity's value is deeply negative. Graham would look at Qnity's trailing price-to-earnings ratio of 50 and call it outright speculation.
But Graham was analyzing railroads and textile mills in the mid-20th century. He was looking at companies whose primary assets were like steel tracks and factory looms.
Human psychology and the math of compounding haven't changed since the mid-20th century.
The nature of capital has, though.
But fine, let's move out of the industrial era. Let's look at Peter Lynch, who specifically specialized in high-growth companies. Lynch's golden rule is the PEG ratio, price to earnings relative to growth.
Yeah, the classic PEG.
It measures what you are paying for the growth you're getting. He wanted a PEG under 1.0, meaning you are paying a fair one-to-one price for the growth.
And Qnity's is higher.
Much higher. Qnity's trailing PEG is 1.54. They are carrying an irrational 50x PE multiple against earnings that are essentially flat.
Flat?
Yes, in fiscal year 2025, their earnings actually contracted by 0.14%. Lynch wouldn't see a hypergrowth superstar. He'd see a slow grower priced for absolute perfection.
Well, that assumes the GAAP earnings, the standard accounting earnings, accurately reflect their growth, which in semiconductors they rarely do.
Then let's look at cash, which is Warren Buffett's ultimate metric. You cannot fake cash.
True.
Buffett focuses on owners' earnings, which is essentially net income plus depreciation minus the capital expenditures needed to maintain the business. It's the actual cash an owner could pull out of the business without hurting it.
Sure, I know the formula.
If you run Qnity's numbers, their owners' earnings sit at roughly $905 million. At a standard 10% required return, those cash flows support an enterprise value of about $9 billion. Yet Qnity is currently valued at nearly $33 billion.
Okay, but
I see why you think that GAAP earnings might be misleading, but let me give you a different perspective. Applying Buffett's owner earnings to a stock isn't just an old-fashioned exercise. It's a gravitational constant. A $33 billion valuation on $900 million of owners' earnings isn't an investment. It's a suspension of gravity. At what point does the narrative have to answer to the math?
the narrative answers to the math when the investment cycle transitions into the harvest cycle.
Oh, the harvest cycle.
Yes! That is the foundational dynamic of the semiconductor industry. You are applying manufacturing-era frameworks to a modern intellectual property-driven firm. Let's break down exactly why those legendary frameworks misfire here.
Please do, because a $24 billion gap in valuation needs a pretty massive explanation.
Gladly. Let's start with Graham's liquidation math. It entirely ignores the reality of intangible assets. If you value a tech company based purely on what its physical office chairs and servers would sell for in bankruptcy, you will literally never buy a tech company.
Okay, fair point on Graham. But what about Lynch and Buffett?
Both of their models are deeply penalizing Qnity for its research and development spend. Qnity spent $354 million on R&D. Under standard GAAP accounting rules, that entire amount has to be expensed immediately, right off the current year's income.
As it should be.
But it suppresses their net income, which artificially inflates the PE ratio that Lynch cares about, and it artificially depresses the owner's earnings that Buffett cares about.
But R&D is a very real expense. Cash actually goes out the door to pay those engineers. It's not some phantom accounting trick.
It is cash out the door, absolutely. But it is not a maintenance expense to keep the lights on. It is a growth investment that creates massive option value. And we have objective proof that this investment is working.
Objective proof.
Yes. If you look past the standard SEC filings and check the USPTO Patent Citation Index, Qnity has an incredibly high score. Competitors are constantly citing Qnity's patents in their own filings.
Meaning what, exactly?
In the semiconductor material space, if rivals are citing your patents, it proves your innovation is the foundational bedrock for the next generation of chips. They literally cannot invent the future without referencing Qnity's past.
Okay, but
That technological premium is simply not captured by Buffett's strict demand for an immediate 15% return on capital. Buffett demands present-day cash extraction. Qnity is optimizing for future monopoly power.
I appreciate the theory of optimizing for future power, but let's talk about how they are actually financing that future, because this brings us to what I consider the media blackout red flags buried deep in their footnotes.
Red flags?
You mentioned they are investing for the future. Do you know how they're paying for it? Through a completely reckless debt explosion.
I wouldn't call it reckless.
Long-term debt skyrocketed from exactly zero in 2024 to $4.0 billion post-IPO in 2025. They levered up massively. As a result, their quarterly interest expense in Q1 2026 jumped to $126 million.
Interest rates are high right now. Everyone's feeling that.
But that is $500 million a year just to service the debt. $500 million. It's like they're taking out billions in high-interest loans to build a massive gold-plated toll booth on a dirt road, just, hoping the state routes a highway through it eventually.
That's quite an analogy.
And while this debt is piling up, their cash flow is evaporating. Q1 2026 operating cash flow plunged 72.5% sequentially to just $135 million.
You're doing exactly what the headline writers do. You're pointing to that 72% plunge because it sounds terrifying, but you're ignoring the mechanics of how this industry actually operates. Sequential quarter-over-quarter cash flow in the materials sector is highly volatile due to working capital swings.
Okay, explain that. Why does it swing so violently?
Because of contract timing and material sourcing. Qnity has to buy highly specialized raw materials upfront in Q1 to fulfill a massive fab contract that won't actually pay out until Q3.
Right.
So yes, cash goes out the door, and the quarter looks terrible on paper, but it completely misses the mitigating structural advantages they have. Direct your attention to the highly valuable net operating losses, or NOLs, on their balance sheet.
Right, the tax shields.
Exactly. Because of past investments in accounting dynamics, Qnity has significant NOL carry-forwards. This means they are shielding future taxes at a 28.25% effective rate. That is an enormous amount of future cash flow that is going to be legally preserved from the IRS.
Preserved cash flow only matters if you actually generate an operating profit to shield in the first place. You need income to have an income tax problem.
And the people closest to the business absolutely believe they will generate that income. Look at the insider buying.
Insider buying?
Yes. And I don't mean those automated 10b5-1 plans where executives set up robotic pre-planned schedules to slowly bleed off shares regardless of price. We are seeing non-C-level independent directors buying stock with their own money on the open market at current prices.
Which is rare, I'll admit.
It's one of the most genuine signals of confidence you can find. Furthermore, their supplier concentration is decreasing. They're actively diversifying their supply chain, which improves their bargaining power and radically strengthens their structural moat.
These are the forward-looking green flags that get entirely overlooked and you just stare at the debt load.
I'm not convinced by that line of reasoning because you cannot pay back $4 billion in debt with patent citations and deferred revenue. It takes actual cash.
They will generate the cash.
The company paid $4.1 billion to issue debt and then paid $4.3 billion in financing activities. Aren't we just watching a high-stakes game of financial musical chairs disguised as growth?
No, we're watching capacity building.
I mean, let's look at their warehouses. Their inventory turnover is slowing down, and days inventory outstanding is creeping up. In 2023, they had $534 million in inventory. By 2025, it was $661 million, and it's growing faster than the cost of revenue.
Okay, so
That is a classic textbook leading indicator of softening demand. They are piling up debt to finance operations, moving cash around, and their warehouses are just filling up with unsold product.
that's a compelling argument, but have you considered the strategic nature of that inventory? In the post-2020 semiconductor world, the old model of just-in-time inventory is completely dead. It has been replaced by just-in-case inventory.
Meaning they are holding more on purpose?
Yes, days inventory outstanding is creeping up because management is intentionally stockpiling critical raw materials to ensure they never ever miss a delivery to a major fab.
To avoid bottlenecks?
If a semiconductor plant shuts down for a day because you missed a delivery, you lose that client for a decade. Stockpiling is a feature of a resilient supply chain, not a bug of softening demand.
Either the flu grant that the inventory buildup is strategic and not just unsold product, it still ties up massive amounts of capital, which brings us to the core issue of their economic moat.
The moat is incredibly strong.
Ultimately, a premium valuation like trading at 50 times earnings is only justified if a company has a highly durable competitive advantage, a wide moat that allows them to extract excess returns for years. Let's actually break down Morningstar's 5 sources of an economic moat, because if we apply them to Qnity, their advantage proves to be mostly an illusion.
I completely disagree. The moat is substantial.
Well, let's walk through it. First, intangible assets. Yes, they have branded materials like Captain and Calres, but these provide a very narrow moat. They are niche materials, not consumer-facing monopolies.
But they're critical niches.
Second, network effect. They have zero network effect. A fab using Calres doesn't magically make Calres more valuable for the next fab down the street.
That's true for most industrial materials.
Third, efficient scale. There are multiple capable players in the semiconductor materials market, so they don't have a natural monopoly there. Fourth, cost advantage. We already established their ROIC is 7.36%, meaning they literally cost themselves money to operate. That is a definitive cost disadvantage.
Again, looking backward.
And finally, switching costs. They have some, but combined with the massive debt binge, their overall moat.
I have to stop you right there. I'm sorry, but I just don't buy the idea that their moat is shrinking, and you are radically underestimating the power of switching costs in semiconductor supply chains. The switching costs are far, far stickier than standard financial models capture. How so? Walk us through the mechanics on the ground.
In a semiconductor fabrication plant, a fab, a single batch of wafers moving through the machines can be worth millions of dollars. If a fab manager qualifies Qnity's materials, like Captain or Calres, into their specific manufacturing recipe, what the industry calls being spec'd into the node, they are not going to swap it out for a competitor just to save 2% on material costs.
Because the risk is too high?
Exactly. The risk of contaminating the clean room or ruining the yield of those wafers is catastrophic. If a manager tries to save a few pennies and ruins a $1 million batch, they are fired. Once Qnity is spec'd into the node, they are locked in for the entire decade-long life of that chip generation. I understand the operational stickiness, but being locked into a product cycle does not automatically equate to generating excess economic returns for shareholders, not when the company is heavily levered and spending $500 million a year on interest.
But we see evidence that management believes those outsized returns are coming. The company's executing share buybacks right now.
Buybacks financed by debt?
If management is buying back shares, it means their internal models show the intrinsic value is far higher than the current market price. That is highly accreted for long-term holders. Combine that with the capital efficiency gains we discussed earlier, The fact that they have stable revenue growth while actually lowering their absolute CapEx spend, and it suggests management sees a much wider, more durable moat forming beneath the surface.
A toll bridge for the future.
Yes, they are building a toll bridge for the next generation of semiconductors, and the market is correctly pricing in the future tolls.
A toll bridge built on a foundation of $4 billion in debt, where the cost of capital actively exceeds the return on capital. Let's synthesize where this leaves us today.
Sure.
The fundamental math on Qnity is simply unforgiving. We have 21 distinct valuation models that converge on an $82 consensus fair value. We have a company generating an ROIC below its WAC, meaning they destroy value as they grow. We have definitive mathematical rejection from the frameworks of legendary investors like Ben Graham, Peter Lynch, and Warren Buffett.
And I still say those frameworks miss the point.
And when you strip away the accounting goodwill, you're left with a negative, tangible book value. From my perspective, Qnity operates as a dangerously overvalued story stock, hiding its deteriorating cash flows and massive debt accumulation behind the general, hype-driven momentum of the semiconductor industry.
And while I completely understand why the snapshot looks severely stretched to a traditional value investor, I maintain that those standard multiples inherently miss the mechanics of modern technological dominance.
The invisible green flags.
The green flags are buried, yes, but they are incredibly potent. You have patent leadership mathematically confirmed by the USPTO. You have deferred revenue signaling locked-in future growth. You have highly valuable NOLs preserving future cash flow from taxes and dropping capital intensity, proving real operational leverage. They are laying the groundwork for a massive, sticky, high-margin future that backward-looking frameworks like the Graham number are just structurally blind to.
Well, it really highlights the absolute necessity of reading the footnotes rather than just skimming the headlines. We are left with a fundamental, unresolved tension between historical valuation math, which screams that a bubble is forming, and forward-looking operational signals that suggest the foundation is much stronger than it appears on paper.
Couldn't agree more.
So, to our audience, you will have to dig into the material yourselves. Examine those debt schedules, look at the patent citations, understand the working capital swings, and decide which indicators carry more weight for you. Because in the end, whether you're trying to measure a solid building or a shifting cloud, the market will eventually force a reckoning between the narrative and the numbers.